Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by Onyx Group, a global search firm dedicated to the commodities sector. Today we're talking the democratisation of oil trading. If you or I or a small business wanted to participate in the wholesale markets, there are significant barriers to entry, both around the cost as well as the price you're exposed to. As the oil markets get increasingly financialised, will they also become like FX or indeed crypto with a much broader range of participants? And what would that mean for the existing market structures? Here to talk about the democratisation of oil trading is Greg Newman, founder and CEO of Onyx Group, a major liquidity provider and market access provider in the energy markets. As always, you can really support the show by leaving a positive review on the platform you're listening on. It really does help us expand our audience and allow us to continue to get great guests. Written reviews in particular, or subscribes on YouTube, all great. Thank you very much. And as always, I hope you enjoy the episode. Well, Greg, welcome back to the show.
Thanks for having me, Paul. Really enjoyed it last time, and thanks for the book launch as well. That was great.
Yeah. And so our last episode was summer of 22, the financialization of the oil markets, which was one of our more popular episodes at the time, and recommend listeners to go back and check that out, as it's the backdrop to today's discussion, which we're picking up and sort of taking forwards whereas the market developed, and talking about essentially the trend towards democratization of oil trading. Can you just give us, before we sort of dig into today and now and changes, can you give us just I remember sort of clinging on with my fingertips in that episode, but essentially, if I get it right, the thesis was that post-global financial crisis, oil trading moved to exchanges, the contracts had got more granular, particularly around options, and essentially allowed producers and refiners and so forth, or physical participants, to much more clearly and closely hedge their future physicals. And it itself then had quite a profound impact on how the market trades and where volatility sat and lay. Is that right? Can you give us the 2 minutes?
I think that's a good summary. But in essence, the market got opened up in 2012 when the exchanges decided to list the oil swaps, as we call them. But essentially, I like to call them now the wholesalers contracts. So this is the contracts that genuinely do price the physical that we consume every day, and obviously producers produce. So it was this opening up of essentially the real market. What did that mean? Like you say, people get much more accuracy in their hedging, but because things are more centralized on exchanges, there's a lot more transparency, and that put people on market. That reduced the barrier entry to quite a big degree, because everything before that was all bilateral with banks. And then, we've just been on a essentially decade plus growth trajectory of people being more empowered, taking more ownership over the hedging, and volumes growing as a consequence of it, and less margin ultimately for the bigger guys. But, the point for today is we've got another big step change to go. And I think it's all well and good having a market that is more accessible for the immediate industry, which is exactly what's happened in the last decade. But energy markets are a hugely important part of our global life as people, right? It's almost 100% of our daily needs. And I think estimates, 10 to 15% of global GDP. This is the biggest market. And would you really say the financial market is allowing for that, or demonstrating the equivalent of that, if you like? The easy comparison is foreign exchange, which is believe it or not, a 2 quadrillion a year notional volume market. And we've got around, estimates anywhere between kind of 50 and 80 trillion in oil. So we've got, oil and energy. So we've got just astronomical, 50 times more growth, at least, considering foreign exchange and other markets are also growing right now as well, to get oil and energy more on a level playing field for the end consumer. So in a nutshell, institutions and the industry have benefited greatly in the last decade. Now it's time for the rest of the world. And it really is as simple as that.
Yeah, interesting. And just one comment, I guess, at the same time as, and it's chicken and the egg to a certain extent, at the same time that you had these opening up of these swaps contracts and others, you also had the need of, we've done a lot of work this year on the podcast on asset-backed traders, They also faced a more volatile environment these last 5 years. There's pressures around obviously capturing that margin, managing the risks, and obviously anticipating and preparing for the energy transition as well. So you've got this kind of confluence of both the availability and ability to trade these contracts at the same time as the necessity driven by recent volatility.
Yeah. And I think what 2022 did in particular was really shine a light on the existing infrastructure and whether that was working for the entire global economy. And it really did create the meltdown, right? If we look back at that, that was a huge event that I think we'll look back at and think is the equivalent of a financial crisis, but in energy. And to your point, for traders, asset-backed traders, there was, the biggest of all companies were being margin called. This is an incredible thing to happen. And as I say, it had echoes of the financial crisis for banks. And so a big, good, hard look is needed in this market.
Yeah. Okay. And then using your example of energy affects all of us and taking that sort of FX analogy, for example, a small business like mine, we hedge our FX exposure. And I guess the point being that, many of these end consumers are also exposed fundamentally to the price of energy, either in direct consumption or by impacts of inflation and so forth. And there is therefore sort of logically the potential need to hedge as well.
I think that is absolutely true, but I would like to just go further because I think that in isolation is correct. If you have an immediate use of diesel or gasoline as a driver, or if you're in some kind of transportation business and if you're in a delivery business, you have these kind of direct exposures to the oil price. But I think the indirect one is much more interesting because whether people believe it or not, and they say, well, I drive an electric car, it doesn't really mean anything. Oil is still, at least twice the size of electricity market. And, we're talking about that market as well. This is a huge market that impacts our everyday lives in inflation, whether you know it or not. So I think the IMF said roughly a 10% increase in oil prices translates to a 1% increase in inflation. So you might be going about saying, but I don't really use oil, but you don't realize how much you do. It's in every Amazon delivery, every time you pick up food from Sainsbury's or Tesco, it got there via some form of oil, ships, road freight, and so on. PVC in your house, endless amount of oil is in your house. I could go on and on, right? And I think people do generally know this, but I think they don't quite understand how direct the impact actually is in their savings and certainly in businesses. So I just think it needs to be as well known in that respect so people can basically act on it. But if you don't mind, I just immediately say the specificity of contracts and the availability of contracts immediately helps that. And we'll talk about this more in a second, but you want to hedge, generally speaking, inflation in your portfolio and your pension fund, that kind of thing. There's very limited options right now, or at least until now. And you're looking at, okay, I bought Brent and I think in 2023 it was 1.9% return. But a dated Brent contract would have returned you 4.5% and much better, basically protected you against inflation. That's just like one immediate example, but that's the train of thought I'm going down.
Yeah, and I'm going to dumb it down to my level. The best I can get through my portfolio with my level of sophistication is buying US oil ETF or a commodities index, right? So okay, so let's put a pin in it, kind of at a time date, the last couple of years, whatever. If I am one of these less sophisticated actors, albeit a small company or an individual, what are the barriers right now that means I can't participate in these markets, or at least up until now?
So I think we have to start with the meaning of true access, because when we talk about barriers to entry, there's a lot to talk about in terms of that, in terms of costs and data and things like that, that are kind of more in our face to some degree. But true access is what I think we need to start with, because it's all well and good getting access. And you say, well, I've only got these options to me right now. But if you were to pay enough money, there is a way to essentially ask any retail broker to give you kind of an exposure to any contract. I mean, they literally will create one for you if you're a big enough client. So it's all about the cost you're paying. True market access is on-market access. So on-market access is you're getting the actual industry price or the best price that's available. So it's a liquidity pool, and it's all about access to that liquidity pool and chasing that liquidity pool. So we've come to think this means the exchange, and we can talk more about that, but that's actually not true. It's the participants trading on the exchange. But if you were to trade with those participants directly, they are able to give you a very good price, or literally the best market price, or very close to, in a competitive kind of scenario. But will they? And because there's people wanting to make money and make a margin in between. So I think that's the first part of it. You're either trading directly with people and you're able to get access to people who can give you the real market price, or you're getting passed through to that via intermediaries. And of course, that's, like you say, that's the ETFs, that's the retail brokerages, or that's directly to the exchange, or it's bilateral with a bank. So again, that is ultimately, if we just quickly go back to FX, because it's such a good example, that is the value of Revolut. Revolut didn't just create a product that you can buy and sell foreign exchange on your mobile, and everyone said, oh, that's so great. Everyone said it was so great because Travelex around the corner, and we've got one literally opposite us. And you look out the window and it says dollar sterling right now. We'll basically convert it for you at 117 sterling to $1. The real market price is something like 1239 or something. So basically, this enormous spread. You're talking like a 5% spread. So you're losing 5% of your money just to convert it, because how else do you access the market? Whereas Revolut came along and said, you can convert probably one of the best prices in the market. I mean, that's quite a profound thing to say that maybe is not realized enough. But Revolut themselves will say, look, you probably lose about 0.2% or maybe even lower on our transactions because of the natural bid offer in any market. But they really are bringing you right to the core of that liquidity pool. So I think we have to start with that, because that is such a massive disintermediation, and the barrier to entry is the barrier to true access. So, don't get me wrong, this comes with a lot of losers. And I think depending on what you read and what you estimate, I think IMF estimated that between 10 and 40% of bank revenues disappeared with companies like Revolut, which you'd expect to. There has to be a loser in this, but obviously there's a huge benefit to the rest of the world. But the other thing is, it doesn't necessarily have to be a bad thing for anyone, because if the overall market grows, you might be taking less of a share, but there's a bigger market for everyone to play. So I guess this is the first thing. Getting true access is the first barrier to entry. And right now, basically, if you're an everyday person, and actually worse than that, even if you're quite an astute professional investor, the only real access you can get is Brent and WTI. We've got US gasoline, actually New York Harbor gasoline, and New York Harbor heating oil. Now, that isn't particularly useful if you're sitting in Gloucester Road, where we are. Like, I don't really care about the US New York Harbor price for 10% ethanol, all this crap that's going in there. That's not the gasoline I'm exposed to. So how can I really relate to this contract? If I go on Revolut, I get the dollar sterling that actually impacts me. So there's a huge step that we need to bring it to this true access to true contracts that actually have a meaning to us. And that's the big step we need to see. And yeah, ETFs like Brent, or US fund is WTI. But again, this is just the prompt month. What about future months? What about everything around these? There's a hell of a long way to go just from that perspective. And then there's all the fees if someone was to open up these contracts to you, which obviously that's what Onyx are doing, but I'm sure others will as well. It's then, well, we're going to take a huge spread. And it's all well and good you getting access to a contract, but what if you have to pay a huge margin in order to do that? There's no point. And again, it's not really relatable to you, because you're just wasting away money just by transacting. So to really remove the barrier to entry, we need to get that like on market price to a very specific contract. So yeah, I think that's where we'd start as the major one. Do you want to go from there?
Yeah. No, I'm about to check out Revolut.
No, they're salesmen, I think. So yeah.
I do get upset with my bank when I transfer money to the UK or something. At the exchange rate that we get offered. Okay, so how does one other piece as well? Just is this will be true in any circumstance, right? As well as, but of course, if you're participating in these markets at a sophisticated level, you also presumably have access to a lot of data to make those decisions. Some of that's proprietary, but a lot of it's now also democratized. Are we sort of seeing, as we saw with the sort of the expansion of different swaps contracts and so forth, and unlocking other people to be able to trade, are we also seeing at the same time as this a democratization of the data that people would need to be able to be informed enough to participate in these markets?
In short, no. I think we still have a market that isn't working for the end users, right? We don't have enough competition, innovation, and I think the big thing is like extortionate costs. So I think the boom of this market we still have a big infrastructure layer that, ultimately there's a form of protectionism there, and that's basically hugely costly. So just by removing that, we're talking about, lower bills for everyone, like if you go down the chain. But I guess to stay on this point, the cost of access to, if we could just define it as the wholesalers market, because again, people get confused. They say, yeah, I can trade the oil price. Like, no, you're trading one particular contract. The one that matters to you is a very specific contract, and it has a very different price. And there's an entire industry that makes all their money in the differential between that price and the price that you open up on your, your app right now. That difference in price might seem small, but it's where all the money really is made, unless you're a producer. So right now, if you want to get access to this wholesalers market, well, first of all, it's considered niche, right? It's OTC traded, it's voice traded. There's this very clunky way of trading. And I think the more and more I'm looking at it, the more I'm feeling this is by design, right? I mean, ultimately how it's set up and how it's not really changing. So first of all, you need the capital to pay margin, right? That's the same for any retail brokerage. And, you're not going to get around having to pay margin or front some capital, but it's the margin for these contracts are particularly high. But at the same time, it's because the only place you can get access to these contracts, before Onyx, I guess, is by accessing the exchange. How do you access the exchange? Well, you've got one of two options. You can directly access to the exchange as a clearing member, but then you're talking, they've got to accept you. And the clearing members are people like JP Morgan and Goldman Sachs. I mean,
they're not gonna accept me, basically.
Basically, I mean, it's hard enough for companies like Mercurio. I think they did it not so long ago. But, they're a huge established company, and they've only just done it. This is not Paul Chapman getting its exchange membership. So the cost of entry there. But then, of course, you're going to go via a clearing member. So that's absolutely fine. The clearing members can pass on access to whoever they like. They're at risk for that, but they front up the financing or whatever, however they want to do it. And those clearing members are kind of, they've got their own market of battling each other for getting customers in via them and charging fees and the rest of it. But then why would a bank give you that access? You're going to need to make some good fees, right? And again, you're asking for very niche contracts, and they're saying, well, why do you even want to trade this? Let me understand your business model. This is a long process. I mean, even for us at Onyx, we had to, show that we'd been at Mandara, we'd been doing this for a long time, we understood everything, explain how we were going to approach it, all that kind of stuff. And they're not going to care, at least, unless you're at least giving them $100,000 in fees a year, I would say. What's the point otherwise for these guys, given all the what's associated for these contracts? But then you need to put the capital down. The clearing members aren't going to give you that capital. They're going to finance you in some way, yes, but there will still be an element of decent cash up front. So that's roughly 15% of the notional if it's going by the exchange rules, and maybe a bit less if the bank decides to take a bit of risk on you. But we're talking like an absolute minimum of $1 million, and probably more like $4 to $5 million just to be trading. So you're going to have to be a hugely wealthy individual, of course, a capitalized business. But then, okay, so they've allowed you to have access with a strategy that they're aware of. Okay, but now you need to get access to the trading venue and the data just before you even get started. Like, who are you going to trade with? You're going to trade on the exchange, but these contracts are voice brokered. A lot of them are voice brokered, and the people are out there, but the way you access them is having access to a broker. So you've got to firstly get an idea of where things are, what trades are going on, what's Brent doing, what's things related to it doing that I can get data for. That's going to run you 20, 30 grand a year before you've even started. And that's just for basically market access data, if you like market visibility data, let's say. Then you've got to pay for the price reporting agencies in oil and energy, right? So that's very important data, because if you hold one of these contracts, these wholesalers contracts, they're financially settled, but if you take them to expiry, you have to know the precise settlement value. Otherwise, you're going to be at risk of losing money. You need to know what's going on. So that's their own data set. That's not the exchange's data set. That's the price reporting agency's data set. And they know you need it. So we're talking another 20 grand per user. But if you're a firm like Onyx, they'll say, 500 grand. And, we'll pump it up by 300% in a year if we want to, which, by the way, one of them did actually try that. So you've got that going on. And then we haven't even started trading yet. So then you've got, well, I need to start trading these contracts. I need some way to know where the bids and offers are, and there's no screen here. So what am I doing? Right, the brokers will charge a percentage commission on each deal, on each volume. And again, why are they incentivized to show you numbers? You need to be of a certain size. You need to be of interest to them. So in order for them to tell you what the market's doing and to basically not to make sure that you're not offside, they're going to need some incentive to do it, or even if it's just an attention thing. So if you're not paying, or at least doing, let's say, 100 lots a month, which by the way is pretty small in our market to be doing that once a month. But if you're not at least doing that, then just don't even bother, right? You just literally not going to tell you what's going on. But then once you've done the trade, so we haven't even got to the trading and we've spent an awful amount of money. And now we do the transaction. Now with futures, you pay $1 per lot. So a lot size depends on the contract, but it's usually 1,000 barrels, right? So again, one lot, 1,000 barrels, 1,000 barrels at $75 a piece is actually quite a lot of money, even though that's the minimum size. That's quite a lot. So yes, they have mini contracts, which can be divisible by, 10, but they're not very common. And I think they only really exist for a couple of contracts. So basically you have to be trading in decent size to even start this. But anyway, that's $1 per lot to basically post on the exchange. The exchange would take $1 for a lot from you. And that's the exchange clearing fee. That's to handle all the processing and all that. If you do it with an exchange, a wholesaler's contract, on the exchange, you also have to pay a block fee. So this is just a transaction fee for having gone through a broker. And if it's not gone through a broker and it's gone through directly on one of the exchange platforms, it's actually a similar price. So you basically got to add another $2.75 a lot, roughly something around there, on top of what you were paying for the future. So just to transact, an incredible amount of money. And so you just bring this all together and you think that as a barrier to entry. I mean, of course it's not people, but it's not even small businesses. It's not even medium businesses. It's a huge ask to be trading and getting this real liquidity. So what do people do, generally speaking, who need the most protection? They go to banks or they go to people who will finance the transaction. But the banks will turn around and say, well, look, I'm taking all this credit risk, I have all these fees to pay. You're going to get a terrible price, whether you know it or not. And even if you tell me, look, I can see on Onyx's data or something, they got cheap or whatever, nice plug there. They don't care. They'll say, yeah, but what are you going to do about it? You can only access it through me. And I don't want to, I've got a lot of credit risk with you. So I'm charging you a bad price. And that's the way it is. But it's gotten to that point where the exchanges are ramping up their costs every year. So we're talking about all the data we just talked about. Those fees go up and up and up. Basically, every cost goes up and up and up. And, business like Onyx, we are, we're the largest volume players, largest market makers in the world. So we are big, but, we pay $75 million a year in brokerage. So we haven't even got to the trade yet. We're just talking about arranging fees, essentially. And all these other companies that are ramping up their year-on-year growth and really putting the squeeze on customers in the industry, it's gotten to that point where it's just squeezing everyone. And it's all well and good when you have a year like 2022 or even 2023. But when you have a year like 2024, the margins are compressed, the volatility is down. It's very hard to make money. And you're paying, basically, it's in some cases, double the costs that you were paying 3 years before. It just puts the squeeze so much on your business that either businesses are forced to get creative or obviously use other channels. And I think that's where we're at. And just, I guess, to finish this point, ultimately, bundling is the clever thing that the big companies do. And this is all the subscription services. This is like the research companies, the data businesses on top, the Bloombergs, let's say, the Keplers, the energy aspects. There's businesses like that you can optionally get that data. So I know we talked about democratization in terms of you can get access to that data and that data is readily available. Yes, but at a cost. And they will ramp up that cost year on year. So they're all doing it. But the clever thing they all do is they bundle. So if I was to say with ICE or CME or any of these exchanges, they have certain costs that they know, you need, or the things that you're actually going to use, and they'll charge you for that. But they might say, or a PRA might say, or someone else might say, but actually, I'm going to make you pay for 5 different services, knowing that you only really want one, but you have to have that one. And I know it's a must have. So essentially, you're going to have to pay this huge fee, and that's
this is if you want cable, you have to get a landline type stuff.
It's precisely that, and people obviously stomach it, and it is what it is. But it's been so concentrated, and more, and it's getting worse and worse and worse. That your original question was, this democratization, has it, where are we at with it essentially? And I'm saying it's hit a roadblock because of even the industry is feeling the pain. So what do you think wider people are going to do?
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
It's fascinating, isn't it? And it's kind of pressing these huge returns that have been made. Everyone was fine, right?
Yeah.
But suddenly you have 24 and who knows what the future holds. But actually, suddenly this becomes quite unsustainable for certain individuals, or sort of certain companies, and again, it kind of comes back to a thesis that we've had on the pod for a while, which is, or at least I've had, where we haven't seen any really new entrants, right? Even into the wholesale market. You haven't seen new trading houses being launched. You haven't seen, there are very few mid and small size commodity traders precisely because of this, also compliance and regulation and so on. So again, it sort of, it all actually makes it, you're not getting that sort of the transparency, liquidity, all those pieces.
Yeah, I think there's also the educational part, right? So I think, again, going back to this tiresome analogy now with FX, but if you look, if a generic person who kind of understands their oil exposure wants to hedge against oil, they're not even aware that there's these wholesalers contracts. They will just look, as I keep saying, to what there's immediately available, and they don't actually know. There's in theory a contract or there could be a contract for every single physical in the world.
Yeah, any exposure you might have, yeah.
Yeah, exactly.
Okay.
So, could I just finish that? Because it's interesting, because I actually read, not even that long ago, Prince Harry was in the ICAP charity day. You know how they get in all these celebrities and it's brokerage free for the day, and they give all the brokerage they make to charity that day. It's quite a cool thing. But anyway, I think Prince Harry was sitting in a newspaper. He was quoted. He's saying he was basically broking a deal with BP and someone, and he had to do the recap. He says, NWE 3.5%, fuel oil barges half at a quarter, and then he just finishes being like, "What the hell did I just say? Like, what is going on? Like NWE 3 that's this, actually quite a very popular shipping fuel contract. But why does it have to have that name? Couldn't it just be shipping fuel for, in the Amsterdam or the ARA port? That would be a bit more of an easy thing to understand. Do you see what I'm getting at? There's all that going on as well.
There's sort of an esoterica about it, right?
There's a language.
And again, it's sort of this turkeys don't vote for Christmas, right?
Yeah, that's it. Yeah.
This works for all of the incumbents, and it's God bless capitalism, right? But in that same vein, obviously, nothing destroys high prices like high prices.
Yes.
And I think the easiest way to ask this is, if I can, say we're 10 years from now, so it's 2035, and we're all doing well. Just sort of extrapolating this thesis forwards, this idea that actually some of this is unsustainable. You've got advances in technology, all these pieces coming together, and as well, there's a growing demand from broader suite of consumers to actually have some kind of better access to these contracts. How does the world look in 10 years, in your view? Obviously informed by what Onyx are doing at the moment, but what bits of the current setup are eroded, and how are we getting that on-market access and at the Revolut price, to extend the analogy?
Yeah, so it's all about getting that on-market access. It's all about bringing the end user and the producer basically as tightly as you can, directly as possible. So yeah, we need a lot cheaper access. So in my belief, just to immediately answer your question, yes, this is happening. This is definitely, I don't think anyone can stop this. We're talking innovation around the world. It's a big theme this year, the Musks, the Trumps, all this kind of stuff. Heavy disruption, AI. No one now is sitting in any industry thinking, it's okay, it'll be okay for the next 5 years. If something is due to happen, it's going to happen now. So I think, again, what is underappreciated is the power of a financial market. So the financialization of oil, like we talked on the last podcast, has a big utility in the world. So with the shale oil industry, for example, they were able to get all their financing up front with a immediate hedge in the the Canada spreads or whatever the WTI contract looking forward. So if you lock that in and it's very close to the actual deliverable oil that you are producing, then happy days. Here's your financing and go ahead. And they were able to hedge so effectively and so in such large volumes that they sustained a huge sell-off in oil price. And when OPEC went to kind of fight on a market share basis and flood the market, they lost because ultimately the shale oil providers were hedging. And so it just provides a robustness in cash flow and therefore a robustness in operations and production. So if you extrapolate that out and you do it the other way as well for consumers, the more people can participate in the market, the better the financial market and the more specific and useful it is for everyday people, the more likely they're going to be able to use it for their own needs and for their personal savings. And for, you can actually get closer to reflecting supply and demand in a much more real time. So imagine if there was a contract for every single major area that was producing oil. When I say major, I mean like, towns and cities, not countries. As I said, like South London gasoline pump price, for example, there's no reason why we can't create a price for that. You're just basically linking to a liquid contract with freight and duty differentials and a currency conversion. And you've got the pence per litre and you kind of wear the variance in between there. So in 10 years' time, if you can imagine a mass adoption of basically financial trading, that, to be fair, can only come once there's the specificity of contracts that exists. So we need a big contract boom. We need liquidity on those contracts, and we need them going down, down the curve as much as we realistically can do it. And then you've basically got an interchangeable network and a very way to reflect genuine consumer and producer supply and demand live in the future. So I think what happens is essentially the visibility, of course, goes through the roof in terms of what energy prices actually are, oil and energy prices are today and what they will be. Governments can forecast better. They can actually hedge themselves. I think there's a lot more basically security. And actually, I think it reduces the volatility. And it's something I said in my book, right? People talk about financialization, meaning volatility. Well, there was that study by the CFTC showing the onion futures before when they were banned or before when they didn't exist and after once they were banned, they were more volatile than when.
Much more volatile.
Much more volatile. So we've got that scenario. I mean, if you can basically extrapolate what we're talking about in terms of the players, we didn't even get to how the price is set right now. The price is set by trade houses and majors who are the only ones allowed to be participating in the tendering windows of the price reporting agencies who use that information to settle the final price. Well, they actually settle probably 98% of the price using the financial market and 2% using the kind of physical information they get as a differential. And hey presto, there's your price. But that price is very commonly distorted from the actual price. So what you will pay, at the pump right now, or what would be sold to you at the price, or what the demand is at that price, it's not going to really be reflected in these tendering windows. Those tendering windows are people marking their own homework. You've got people who are supplying the world with oil, but only really they have the know-how and the experience and obviously the barrier to entry is, and they're the ones in that tendering window and got approval for that tendering window, similar to that whole clearing members thing. So, and they're setting the price. So once you have a market that's so heavily financialized and so well participated in, I mean, the opportunities are endless, but at a minimum, you'd expect a lot more incremental supply and demand reflection in the actual price, much more so like the electricity market right now. You get very real-time volatility swings based on real demand when you actually get to the delivered component of power. So I don't see why that couldn't happen in oil. And so that would be a massive change. But I guess it's the growth of these contracts and the utility of these contracts. I think it would change the way people manage their savings. And ultimately, we're talking about that being on your phone and your app as much as anything else. And in terms of who loses, well, that's the interesting one, because again, there's this concept of, well, if more money is dispersed, someone's losing, and that's true. But as I said before, well, if the market just times by 50, then the people that were making a lot of money, the exchanges, the trade houses, the majors, the price reporting agencies, they will make less per unit, a lot less per unit, but they will still be part of the infrastructure that is globally exists. So why would they not still make maybe even more? Do you see what I mean? So there's nothing to say necessarily there'll be losers, bigger pie. Yeah, exactly.
So one question, then I want to talk about how we get there. The list you just outlaid there, majors, the wholesale participants today. What happens to the brokers in that 10-year future scenario?
So brokers, again, I think is actually quite a promising one if they want to look at it in the right way. Like right now, they only trade with industry participants, and they're acting like an exchange within an exchange. They pull liquidity together, they arrange these deals, then they post it on the exchange. There is, like, they know themselves. There's not really any use for that. But brokers exist in every area still, every market still. So why do people use brokers? The amount of people that will need, to have their hand held or just some guidance, essentially they'll become like stockbrokers, advice, trade ideas.
Yeah, it's advisory.
It's advisory, but it's actually the way that advisory gets paid is through execution. So there'll be much more of a dealing function to a broker, in my belief, and they'll essentially just take a bid offer rather than a commission. And it will still be very tight for the end consumer, like in foreign exchange right now. It's all very efficient. So I think they'll be absolutely fine in that front, but they will stop charging commissions. They will start charging bid offer, I think is my belief long term. And I think, brokers also in stock markets became financial planners. So it's the same thing. We're going to need a lot of people with a lot of expertise speaking to a lot of businesses and people even about how they go about this. And I think that will be a huge boom for the brokerage industry, but not as it currently exists for sure.
How do you get there? So, for example, increasing and expanding the contracts even further to this idea of you can hedge in Southeast London. Who creates those contracts? And then don't you run into the sort of the issue of liquidity again, which is, well, how many people actually need that contract? Or are we talking such a scale of new participants that they're going to be in all these markets at all the time?
I don't want to give away my full business plan, but I think that
sorry,
I think that's the challenge, and I think that is what our role is as one of the market makers. And I think everyone has a part to play if they want to have a part to play in this. And I think, as you just very accurately said, liquidity is a huge part of that, and so the liquidity needs to be there. But again, you look at ETF markets and these contracts around the world, unbelievably liquid. And every single one of them, Indian ETFs, it's a huge business now. Like, who knew? And that's Jane Street doing all their trading there and all that. So I think that liquidity won't be an issue. I think that that's something, liquidity begets liquidity. And I think there's very smart people out there. There's some very good technology out there. I personally don't think that will be the problem. But I think, as you say, the new contracts, that is potentially a challenge. And there's got to be a rapid creation of those contracts. They've got to be accessible, those contracts. So what is your mechanism to trade them? And remember, like, a hint here would be, obviously the crypto market. I mean, the crypto market, we have Trump coin and Milena coin, and we have, the Hock Tour coin. But like, these are new contracts. And I think if you just use that mechanism.
Prince Harry and the Hock Tour girl on one pod.
Yeah. So this is what I'm saying is this is not new technology. This is not new concepts. It's new concepts for the industry, but it's kind of merging them together. And I personally don't think that will be a problem. I also think that this is something that I haven't really thought about in terms of where Onyx play a role, but I think that if the financial market and the very accessible method of exchange and sophistication gets strong enough, it would not be a big step to convert that to physical. Now, people have tried this before, but again, it's the specificity in the contracts. It's all well and good having a physically delivered contract, but it's actually a pain in the ass because a company like Onyx, who doesn't have physical, will have to basically avoid expiry every time. Because if they let it expire, then they actually have a physical supply or consumption obligation, which they don't want. So they avoid it. So it doesn't really have much utility as a contract if no one's actually converting it. So the better method is actually what we have on the Brent futures, which is anyone who's got access to it can take Brent to expiry. It financially settles, and that's done. But there's also the option to trade an EFP contract, exchange futures for physical. Now you have to do a minimum of 700,000 lots, which again, a notional value of huge money. The point is that you get this EFP contract, and exchange futures for physical actually gives you, if you do enough volume, the physical in exchange for that financial position. And there you go. You've actually got the physical that you bought as paper, but that's one contract. And I think it's not an efficient enough mechanism, and it's a whole game in itself, and it's actually 2 months forward. So it's a bit of a mess. Whereas if you think about it, a very sophisticated financial market takes you in the wholesalers contracts, like the oil swaps, takes you, the beauty of them, it takes you all the way in some cases to a price that's actually, basically in 5 days' time. You can get very, very spot with these contracts. And if there's a highly sophisticated contract and it's very clear in its specificity and its region for delivery and all that, why is it such a leap to go from there to exchanging that at the pump, going in and saying, I've got these tokens or whatever it is, I've been holding these as a financial contract and now I want to convert them. Why not, right? And I think that's a lot more of a accessible and doable thing, as provided the financial market gets as sophisticated as what I predict it will.
Yeah. There's a couple of thoughts strike me. I mean, certainly, you'd have to do something about the physical, because you quickly find yourself in a sticky situation if these things are going to term and people are ending up with sort of having to go to Cushing to pick some stuff up. And there's also probably a service in there as well, right? Actually providing, if the markets don't get that sophisticated in actually sort of handling that piece.
Well, that's what the oil traders do, though. That is their job, whether they tell you or not. They are market makers of the physical, and their job is to take it from wholesaler to the end user. So as I say, that differential in market in general is where they operate, and that's where they make all their money. But ultimately, they make money a lot from the physical contracts as well and the optionality around those. So again, you'd imagine these contracts would be a lot smoother the more the financial market is sophisticated. There's not to say they wouldn't have a job, because obviously, as you said, their job would then become, a bit further along the line. They would say, okay, well then I can be the one who converts it to physical, or I can make the agreements or whatever.
Yeah. Where does this leave the price reporting agencies?
So I think that, again, as I say, that there's still a massive need. This infrastructure that we've created as an industry works very, very well in terms of for the participants it benefits right now. If you were to extrapolate this to the end user, there's no reason the services can't extrapolate. So the price reporting agency, if anything, would have a huge job here. They've got to create a hell of a lot of contracts. And to be clear, they do. The way they look at it is they create indexes, not contracts. So they've got an index, or these PRAs have indexes for hundreds and thousands of things, because people actually do need them to negotiate. It's actually the exchange's job to convert that index into an actual future that can track that index at settlement, if that makes sense. So the PRA can probably have a great time doing this. Ultimately, they can produce indexes all around the world in every possible location. And then it would actually be up to the exchanges, the retail traders, the retail brokers, the ETFs, the mechanism for access to access to liquidity, to be referencing those new indexes, if that makes sense.
And I just think about the granularity they can get around teapot refiners and stuff, right? I mean,
but I think that's the big thing. I think what I'm getting at here is, it's the exchanges actually. They are the ones that are probably going to need to change the most, because ultimately it's extortionate, the amount you have to pay to trade and the access to data. If suddenly you can get the same data, if not better data and better access outside the exchange, and yes, maybe the liquidity in some form ends up there, then they've got to find a way to compete and lower their costs, right? And increase the breadth of their offering. And you are seeing that, direct market access onto exchanges for retail is becoming more of a thing in the US, especially. They don't like CFDs. They don't like, people sleeving things. They like real futures contracts that have been kind of chopped up. So fractional contracts, and it's the same with shares and the rest of it. But again, cryptocurrency could be hugely useful in this, but then cryptocurrency exchanges are, very different, and they are cheaper. So I think they're the ones that got to think the most about this. It's a very regulated area, which is what they've got going for them, but it's an unregulated kind of boom that's going to happen next. So where they play a role in that, of course, they could play the biggest role, but it's up to them in essence.
Fascinating. And it kind of does strike me as well, actually, you would assume over the next 20 years, oil and its products are going to have a rocky ride, right? As we go through some form of energy transition, let's say whether that's 20 years or 30 years, that means less investment in the infrastructure, more volatility, higher peaks, higher troughs more frequently. As that infrastructure degrades, the capital environment isn't as strong, the forecasting is tougher. And actually, this is going to be crucial to more and more organizations and individuals, as we sort of started off with. So this is one way in which the market will adapt and will be forced to adapt to enable people to manage those risks, and and also make the investments that are needed. let's finish on Onyx and kind of piece it all together. And obviously, you don't have to share your secret sauce, but it'd be kind of, where do you see your role in this? And this is something you're doing today in anticipation of all that we've discussed.
Yeah, I mean, it's something I'm personally deeply passionate about because, I don't like to see protectionism in general. I think we're always, as humans, trying to push forward, or at least I think we should be trying to. And you can't really fight efficiency. So, in my belief, this is going to happen either way. I would like Onyx to be driving it as big as they possibly can, because, what are we here for, right? This is our job. If we can see it, we should be taking part. So what have we done about it? Well, we've released Onyx Markets, which is actually CFDs. So this is CFDs, which is essentially just a lookalike contract of the futures contracts that exist. And we're working our way through saying, let's list every contract that currently exists. But there's nothing stopping us creating new CFDs for new contracts and working with PRAs or whatever, using our own PRA or something like that. And yeah, we absolutely want to basically say, whoever you are, wherever you are, to some degree. The US don't like CFDs, but we want to be giving you access. Now, what's the difference between access? Again, going back to the very beginning, we are a trading business. We want our numbers to be with everyone possible because we're already at the end of the logistical chain or the transaction chain. If you think about it, like we trade with BP, Shell, Vitol, or whatever, that's the best number, but it's also the worst number for us because we're fighting with this tiny margin. So if we extrapolate that back out like a Revolut, we can afford, if we add a tiny margin, that's huge for us because we weren't making it before. But it got me to thinking, do we even need to do that? Why don't we just be the same bid offer we are to BP and Shell as we are to everyone in the world? And why should we care? We're making money, so let's just do it. So we should just be wanting maximum volume. So we've opened that up, saying anyone can trade with us. Come trade. It's a lot cheaper than the exchange. It's also the same liquidity, so it would feel like a no-brainer. But your choice. And then we need to kind of drive the development of the retail market, if you like, as much as we can. And the other pronged attack that's coming soon is we have set up an ETC, it's actually called, not an ETF. So an exchange traded commodity is actually an exchange traded fund, but for one singular commodity contract. So they prefer you to call it that because an ETF, really the definition is some form of diversification. It's like a basket of products. So we've got an ETC, which is going to track week 3, so spot as we can realistically make it, dated Brent crude. Now, why dated Brent? It's a very particular contract, but it prices 70% of the world's physical transactions. So we're looking at the numbers and saying that dated Brent contract moves, as I said earlier, higher in bull markets than Brent. It gives you more of a reflection of the spot market. So in return environments, it outpaces the return by sometimes quite significantly. So it's basically providing you that specificity to the investor market. So that's institutions, and yeah, retail can trade it too. But really what we're trying to do is get access for, the asset managers, the pension funds. So when they go to get exposure to oil prices right now, we're giving them a superior instrument is the idea. And as market makers, we should be the best positioned to do that. So that's coming to, it's called Onyx Spot Crude. So those two things are like a big part of what I think we're playing our role to do this. But also remember, we are market makers still. So the more liquidity we can be providing anywhere, and that is the exchange, that's retail brokers, that's ETFs, whatever, then we are doing our role, right? And if we can continue to find ways to be better and better at that job, then we should be driving this forward and we should in some form benefit. But I won't hide the fact that the margins have gotten way tighter. We're talking about a very tough year last year. We've invested so much in these projects. We've invested a lot in maintaining and developing market share. We've got a new competitor business starting in market making that was costly. Big legal case, that's no surprise, and was all in the news and stuff like that. So we're all in on this, and we've got a general part to play. But I'm being serious when I say this isn't an Onyx story. This is a world story. Like everything gets disrupted and becomes more efficient, and this is the next frontier. Anyone could be a part of this. So get stuck in. Like we can't keep paying these extortionate fees. We can't keep blocking people out. It's not the way it should be. Like that Thatcher quote, no great prophet or philosopher said, brothers, I believe in consensus. I was reading that the other day. It's true. Like why are we so status quo and nothing can change? That is clearly not the way of the world. So, stand up, get stuck in. And this is going to be a huge, huge, huge market. And that's where we stand.
If my company says, okay, well, I want to go and I want to participate on Onyx Markets, am I posting margin? How does that all work?
Yeah, it's effectively the same as an exchange. It's posting initial margin and it's a variation margin. It's just lower margin than the exchange. because we have autonomy to do that. The FCA has rules around obviously how much leverage, and margin is leverage ultimately. So we've tried to be as competitive as we possibly can, and that's part of the pitch. Is no subscription fees, no transaction costs. We're going to give you all our data up front for free with our platform, as long as you trade with us. As long as you're trading, we're fine. And by the way, the cost is really cheap. So I'm going to put it on other people to say why they're not going to trade with that. But you know what people are like. You know what this industry is like. It's a status quo industry. They're fearful. There's protectionism. And even if you put the best product in the world in front of people's faces, it takes time to adapt. So, that's our challenge. But in answer to your point, it's essentially a cheaper version of an exchange.
Yeah. Well, fabulous, Greg. As always, concise, clear, and inspirational as well, I would say. And, best of luck to what you're doing as well. I think it's fascinating, and I do think that, what is so exciting about the commodities sector is actually all this innovation that's always going on, and these brightest minds in the sector always, competing fiercely.
That's a free market, right?
Yeah, exactly. So, and then we managed to get Prince Harry, Margaret Thatcher, and the Hawk Turgill. So
it's a good title. Cheers, Paul.
Well,
thanks so much.
Yeah. Best of luck, and look forward to checking in with you again in a year or two and seeing where we are on this journey.
Okay, thanks, Paul.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.